All right, we'll just let people filter in for a minute or two before we get started. I don't want to call attention to it, but look at that thick head of hair on the on that slide photo of me. Look at that. Maybe just another couple of minutes to make sure we let everybody join, and we will get started. All right, one more minute and we'll get started. All right, I say we get started. Tom, you ready?
Yes.
All right, let's jump into it. Hello and welcome, everybody. Thanks for joining. We're here today to talk about debt and how it can help you drive your valuation. I'm Keith Harrington, COO and co-founder of Novel Capital. If you're not familiar with us, I hope that you take the opportunity to get familiar with us. We're a non-dilutive funding platform, which really means we provide debt capital to growing SaaS businesses across the United States. We do this every day. We've provided over $100 million to more than 150 SaaS companies to date. We also provide data-driven connections to over 100 VCs for our customers who are interested in raising equity when it makes sense for them to do so. Today, we're going to do a deep dive into why the smartest SaaS founders are using debt to drive valuation and how they are doing it. Specifically, we're going to go over why debt-funded companies can grow faster and get rewarded with higher valuations, how to think about your capital stack as a strategic lever, not just a funding necessity, not just one of those things that you always have to think about and do, and when and how to introduce non-dilutive capital to maximize its impact on your valuation. Um, I have with me today an expert on all of that, and in particular on capital stacks and valuations, Tom Novo. I'm going to say Tom Novotny. I'm going to go ahead and just take a risk and see if I can get his name right. Did I get it right?
Very good.
All right.
Yes, very good.
You underestimated me. Chief Growth Officer at EQVista. EQVista provides valuation and financing solutions for founders by founders. And interestingly, Tom is also a partner of Novels. EQVista is a partner of Novels and a customer of Novels. So we know each other reasonably well. And along the way, we've had a chance to talk a lot about the topics that we're going to cover today. And I know that he's going to add, I suspect, a lot of value to how CEOs who are listening in are going to be able to think about their capital stacks going forward. So, enough from me. Tom, I'd love for you to share a little bit about yourself and the company.
Uh, Thank you, Keith, and hello, everyone. Great to be here. This is a fun experience. It's been a while to join a webinar, so let's see. Yeah, so my name is Thomas, or Tom, and I'm a Chief Growth Officer at EQVista currently. I have always been a founder, for good or bad, in my life. I have sold a bootstrap company. I have exited a VC-funded company. We were building environmental analytics for buildings from initially from Europe, then open offices in New York, and yeah, got acquired during the famous pandemic. And otherwise, I also advise, especially startups, especially around environmental and sustainability related topics. And at EQVista, we focus primarily on valuations. We have a valuations team of accredited analysts, and we pair them with smart and AI technology to be the fastest on the market currently, the best priced on the market currently. And if you go to Clutch or G2 and similar review sites, you will also see that we have, if not most, one of the most 5-star reviews. And we accompany our valuations also with equity management, cap table solutions, and then additional services. So we are building various valuation and financial intelligence, and also you can pair things with things like 83B, QSBS letters, and other things which US founders might find relevant soon, if not already.
Soon, and hopefully sooner than later. Thanks, Tom. That's super interesting. Before we jump into this sort of meaty topic, when should founders be reaching out to you and EQVista to actually engage you and your services?
That's a great question, actually. Thank you. I skipped that step. So we have about 22,000 companies on our platform, from pre-seed, really as early as founders are splitting equity between each other, to pre-IPO companies. We have several unicorns as customers. And when it comes to valuations, we have valued over 100 billion in equity for these clients. And yeah, I think that we have built interesting data set and interesting insights from that.
All right, great. Yeah, I'm looking forward to digging into some of this data and some of the insights that you and your team have uncovered. Before we dive in, just to let everybody know, this is a totally open conversation. Please feel free to ask questions. The best way to do that is to use the Q&A button at the bottom of your Zoom screen. If you ask a question, I will catch it and I will make sure that it gets asked so that you can get some expert advice from Tom. Don't be shy. We love questions. That makes the conversation much richer. So don't hesitate. Please do ask. So let's get started on the actual meat of the conversation. Tom, you guys have data across hundreds of customers, right? And it shows how they do across how those customers do, those companies do over time and with a bunch of different capital stacks. Tell us some of the data, some of the results that you've seen that you think are interesting.
Yeah. So what we did specifically for the webinar as an exercise. So we have, as I mentioned, data from thousands of companies. We try to create it and build it into useful benchmarks for others to guide founders and kind of that you can see and get a little bit of sense where are you in terms of performance and how you are using financial stack, or where are you with the P&Ls, balance sheets, and so on. And we have zoomed in on about 400 VC-backed companies. And then we selected those who found the right amount of debt. That, of course, it's not science, so you can't say exactly precisely what is the right amount of debt. But I think that we selected some sort of range there, about 50 companies. And when we were comparing these groups together, so the companies who optimized their debt and paired it together with equity raises, they were growing faster, significantly faster. And it depends how you look at the data, but the control or the full group was about 110% growth year on year on average, and it was over 160% for the group which we selected, who optimized both the equity and debt raises. And they got lower dilution by a few percentage points. And also they raised at higher multiples. So if you calculate the revenue, or if you look at the revenue and the valuation they raised at, the multiple is significantly higher for these types of companies. Obviously, it's always difficult. It's a little bit sometimes a chicken and egg, right? So what is the direction of the relationship? So there is a correlation, obviously, but we can't say, hey, those who took debt are guaranteed higher valuations, or the other way around, right? So it's always a mix, and it's very case dependent. But I think that the correlation is a good indicator that there is something about finding the right right way of financing your business and especially growth.
Yeah, I think that's some of this is actually super counterintuitive, right? Like these are not the kinds of things that you would expect to hear. It's not the sort of results that you would expect to see. And if I step back just for a second, everybody's probably familiar with the idea of most people are familiar with the idea of I need to optimize my capital mix, my debt to equity, my debt and equity mix as I grow my business. And it becomes more and more important as you grow the company. And at the earlier stages, as when you're a startup and then you're growing into the first couple of rounds of equity, if you're not going to be raising equity, you're bootstrapped and you're getting into the first couple $1 million worth of revenue, you know, taking debt gives you some very obvious advantages, right? It is capital without dilution, which means you get to keep your company and all of it in some cases. It is a way it's almost a forcing function on rigor, financial rigor. To get debt, you have to have some level of reporting, and your level of sophistication sort of rises once you take a certain amount of debt. And it's cheaper than equity, right? In pretty much every case, if you think about equity is sort of asymptotically expensive, right? And the more successful you are, the more expensive equity is on a dollar basis. Whereas with debt, you kind of know here's what I'm going to pay, and if I can put $1 in a machine and I can create $1.50 with my machine, but I only have to pay $1.10 for that dollar, then that's a good mix for me. So once you really understand your unit economics, it makes a lot of sense to take that because it can be so cheap. Um, all of that said, these are the sort of like the table stakes basics for taking on debt for an early stage company. But growth rates being higher than the rest of the cohort to me is counterintuitive. And I'm curious what you think about that. What does that really reveal? I don't think, I don't think it's, well, if you take debt, then, like you said, it's not, if you take $1 in debt, then you're just going to start growing way faster. It's not that. But what do you think is the subtlety under there that people can think about?
Yeah. So pairing it with the growth rates, it's very interesting because we haven't
Mhm.
seen that there will be clear indicators why that is so, right? So we can't say like, hey, debt. So this is the faster growing companies raise debt more often, it seems, or also they have more capital to deploy. And I think that maybe it pairs better with what you said, Keith, about the kind of reporting and being more responsible around this, kind of both planning and reporting, right? So when you see it as a founder, when I got debt, I was a little worried about it because in the end, you take VC money and they're not going to ask you to return it in 2 years, right? With a lender, you have to
Right.
plan. And I think it forces a little bit of thinking like, how do I deploy it efficiently so I can return the money in time? And at the same time, the debt, as you go through the process with the lender, it forces you to think about things a little differently, to prepare. And as you are prepared, it's easier for you to raise VC capital as well, right? Because the overlap for what you need to share with the lender versus what the VC is asking for is actually huge. It might be a different way of looking at the same thing. You might present it a little differently, but in the end, you're working with the same data and it forces you to think differently. And I think that's also why those revenue to valuation multiples are higher, because those who took debt, they're better prepared and they have also kind of third-party validation that they are doing
Mm.
this. Is what is the correct term? Dutifully or correctly, properly, thoroughly,
Mhm.
something like
Yeah,
this.
right. Yeah, that makes a lot of sense. I like I think that it taking on a layer of debt, even a small layer of debt, kind of like I mentioned, it sort of creates it creates a new muscle around, if you haven't done it before, it creates a new muscle around reporting and rigor. And I think that really lends itself to, well, certainly to helping raise equity, but also to making sure that in some cases you're for the first time looking at your data in a new way. And that certainly is a big help for a lot of the companies that that we've provided capital to, sometimes we're the first capital that they take. And in some cases, when we are providing that capital, we're asking them questions about their financials and about their business that they haven't really thought about before. And then once we have that conversation, then they see a new angle that they can start to think about too. Maybe a new angle on their unit economics, could be a new angle on how they build their pipeline and how they think about sales cycle, whatever. But generally, what we like to think about is the questions that we ask, the work that we do to due diligence. It should be sort of it should help companies get from where they are to the next phase. Um, just by the questions that we're asking. Hopefully they can take some value from that and use it in their metrics. Um,
At the
should
same time, I think at the same time we should stress out that, because now it might sound like, oh, there is reporting and there is this and that and there are questions and so on. It's not that tedious, right?
Right.
And we have seen this when we talked with some of our clients, why they don't have more debt, even though they would have opportunities for it. I was like, oh, it looks like a lot of work. If you are ready for a seed round, right, you are most likely very close to ready to apply for a loan as well, right? Then you might need to turn things a little bit around or look at things differently, as Kit said, but at the same time, it's not tremendously much more work. You don't need a interim CFO on board. It's great if you have them, but you don't need
Right.
an interim CFO. You as a founder with kind of common sense, you can actually get there, and it's not. Yeah, you don't need to spend the whole weekend on it for sure.
Right, right. Well, I mean, you actually have a really interesting perspective, right? Because you've raised venture money and you've raised capital from Novel. So I would love to hear. I hope I'm not putting myself in a bad spot, but I'd love to hear how those experiences go, how those experiences went for you, and kind of how founders should think about going into each one of those. Because at the end of the day, like you said, these fundraising efforts overlap, but they are a little bit different because I look at companies slightly differently from a VC. So I mean, you've been in these shoes. How should they think about that?
Yeah, and I think that I think we are in a little kind of unusual position to what I've seen before, right? Because the company is self-funded slash bootstrapped, and we have been mostly cash flow positive, so we didn't have this
Mhm.
typical runway. And it sounds good. On the other hand, it doesn't create a sense of urgency among the investors. So it's like, what is your runway? When do you need to close the round? I was like, well, we want to close in Q2, but we actually don't have to. And I think that as we were running in parallel the discussions with Novel and a few other lenders, figuring out what is the kind of a size of the loan we can take and what would make
Right.
sense and how do we structure it, what we take first, what we leave as a facility, and so on. We were also discussing equity investment or convertible saves, and they were dragging their feet in a way. But once we got everything done with you guys, and we decided we will go with Novel, and we signed it, and we told them like, hey, now we have this capital, we are fine to go with this. We are cash flow positive anyways because we can deploy it. Actually, everybody moved forward because then they realized, now is the window. Otherwise, it's going to pass. So sometimes, and I had it with my previous company as well, like creating the kind of the sense of urgency.
Oh
Right?
yeah.
If you don't have the knowledge, it's very difficult. And
Yep.
everyone likes to kind of, let's wait one more month, one more quarter. It feels like a little bit more validation. Usually nothing dramatically change upwards or downwards, but still they're collecting more of the points to kind of figure out your trajectory. With my previous
Yeah.
company, we always asked for debt first, and then we went to raise.
Yeah.
And once we raised, and one of our investors, they actually also had a bank. So once we raised, I went to them and I was like, guys, and now you give us debt as well. and it worked out, and it was good. Uh, and I think that, yeah, especially there, we also managed to preserve a lot of dilution by taking these steps. So that I liked it.
Yeah.
And but then we took a loan from bank, and that was way more work than what was it
Right.
with you. So,
Right. Yeah. Loans from banks are those are actually hard to get.
it was
Those
hard, and also they are not used to look at you. They're looking at you like in different mindset, right?
right.
So they compare you to kind of medium-sized businesses which were around for decades, And it's very different. So, and if they are not used to, oh, we burn cash, we are looking for some
Right.
cash efficiency, but still we lose money. We don't plan to break even in the next 3 years. And the bankers felt very uneasy about it. I'm sure that there are banks which are more familiar with it, but the banks I took money from or debt from, that was fairly new for them. So I felt like we were educating actually the bankers about like what does it mean to have a
Oh
growth
yeah.
company
Yeah.
and then startup and
And in my experience, most banks that do lending to technology companies are going to do it in a venture debt format, which is a little bit different from how we think about it. There are different kinds of lending, and this gets to a topic I want to get to here in a minute. But for the founders out there, there are a couple different kinds of loans that you can think about for your business. There's venture debt if you're venture backed and you have a venture firm on your cap table who has a relationship with a bank, often they can help you get a line of credit from a tech bank, Silicon Valley Bank, Comerica, those kinds of banks. There's the kind of lending that we do, which we don't need you to be venture backed. It doesn't matter to us one way or the other. We're really just looking at the metrics of the business. We are comfortable with companies that are burning cash. We understand that there's a curve that companies have to catch up, that revenue has to catch up to burn sometimes. But that takes, banks don't like to think about the world that way. They're just not built for that. But I think it's super interesting. We know that from your data, Tom, we can see that valuation multiples are higher, growth is higher among the cohort of companies that you have on your platform and that you've selected for. And then obviously companies that have taken debt are going to generally maintain ownership of their equity, more ownership of their equity. The thing that is really interesting to me as well is you shared some data about different kinds of debt and how they sort of play out in a company's life cycle and outcomes. And I just mentioned a couple, right? There's venture debt. There's just, I guess I'll call them fintech loans from companies that are comfortable making loans to software businesses that are not banks. Um, let's talk through some of those. What kind of differences are you seeing among your data set based on loan size, not loan size, loan type, and what those outcomes look like?
We have not segmented it by the type of loans, right? So we see that there are companies who take loans early. We see them who catch up on taking loans later, but we don't
Mhm.
necessarily see through the data what is the type or format of the loan. We can guess it, but it wouldn't be correct to make assumptions out of it. So I mean, if it's a consumer company which
Ah,
delivers something, it might be different type of financing than if it's a B2B SaaS, like in our case, right? So I don't think obviously I can distinguish between those, but I don't have different data points on like if somebody's taking AR or factoring, it's very different type, right? So and I don't,
true.
yeah, we can't really structure it to see some sort of correlations or signals how this adds up. You know?
Gotcha. Okay. Well, so let's talk a little bit about where you have seen some of what kind of changes in outcomes that you've seen from companies taking debt, venture debt or whatever, along the lines of like, I know we talked at one point about, uh, risk of failure, the likelihood of an exit that is, successful. Um, let's talk a little bit about what you've seen there in your data.
Yes. So one part is our data, and the second part,
Mhm.
what we did is kind of a literature review. So we went to find academic research, and I know a few of the researchers who focus especially on venture debt. And so we went through this, and they collected data for past few decades, right? So it's the data set is much more robust what the researchers collected and with it. And you can see that actually taking venture debt, and this is specifically venture debt, it's it reduces the risk of closing down or shutting down. And so the risk of failure is lower. And depending on what types of businesses it was, the risk was reduced by 1.6 to 5, almost 5%. And at the same time, there was I would say, significant increase in the prospects of successful exit, which would mean either the company gets acquired or IPOs. And from the research, it was between 4.3 to 5 was it 3 or 5.4% was the increase in successful exit probability, which it might not sound much, but actually with the odds being so stacked against companies, that's very, very meaningful, I would say. And maybe since you were VC, so you can maybe elaborate how the change of 4 or 5% in the exit probability changes your model.
No, it's a massive change. I think that's one of the pieces of data that I thought was so interesting. Uh, you know, most businesses that start end up failing, irrespective of whether they're venture backed or technology startups or whatever. Your odds of success, no matter what business you start, are incredibly long, and they just get harder the more complicated you make it by launching a technology business and raising venture money. It just is, you add layers of complexity, right? And if you think about uh, VCs, and I speak with some experience, I used to be a VC. If you think about it, 1/4% of companies raise venture capital, right? That's a very, very small number of companies. And then if you think about all VCs across the universe, they are really thinking about their portfolios like, 50% of the companies are just not going to pan out. They're going to be somewhere in the range of a zero for them. And then there's going to be some amount of their portfolio, 25, 30% that will be just 1x. When the company sells, they'll get their money back. And then it's the cream, it's what's left over that really drives all the returns. And so if you think about it, like just the way venture mechanics work, just the way the power law in venture capital works is great proof that the odds are stacked against you as an entrepreneur. So when there are ways to increase the odds of your success, you got to take them. I'm an entrepreneur. Maybe we at Novel, we are venture backed. We have raised debt. We've done all the stuff that we're talking about today, and I will tell you that I empathize. This is a very hard thing to do. And anytime that I can take a little bit of risk off the table or turn the odds in my favor, I'm going to do it just like anybody. But what is very interesting to me, again, is that it is counterintuitive, right? Because what you think about is if I take debt, then I'm gonna have a harder time doing whatever I'm trying to do, and it might put me in a bad spot. And this gets to a point that you and I talked about before we dropped into the webinar around you really have to think very carefully about when and how much debt to take, right? I want to make it very clear that not everybody should raise debt capital, and not everybody should raise it at any point, at every point in their journey, right? There is a sweet spot. There's a point where it makes sense. There's a point where it doesn't make sense, and there's also an amount that makes sense and an amount that doesn't make sense. And I know you brought that up when we talked earlier. I'd love to hear your thoughts on that.
Yeah, so when we were looking at it, we also found that there are companies who actually take too much of debt, right?
Yeah.
And it looks like that they are kind of playing a little bit of a catch up. Maybe they have not met their targets, and then they're increasing the spend, and often then things go a little bit sideways. And I think we should maybe specifically zoom into these types of companies and the data some next time, just to say like, okay, there is a kind of the right balance, and then there is like underdoing it and overdoing it, right?
Right.
And again, like we could talk about outliers, right?
Mm-hmm.
But in the end, most of us fall into some kind of median or average bracket, right? And
Right.
we have one of our investors. He's a founder of soon to IPO startup. And when I told him about the debt and what we were planning to do, what we saw in the data, he was like, oh, okay, well, I'm not so sure because we always could raise. It didn't matter when we raised 20 or 30 million, and we could always ask for more. And it was actually the banks hunting us down to take at least a credit facility from them because they wanted a relationship, right? But that's an outlier of an outlier, right?
Yeah.
They hit it off very well. They were performing very well, executing very well. They had great KPIs. And then most of us who are kind of between the medians and averages, we have to think about this carefully. And so we have seen that the companies who did take debt and who started to work with debt earlier, they did have better performance, right? And when we segmented the data set with the companies who took debt, so we started as low as from $500,000 in revenues, right? So very, very early. For some, it might have been the first money in. And I think that that's also a good step to think about it. I'm crossing $500,000, can I take 100K? Can I show and pass the due diligence without risk, right? And I'm going to collect a little bit of experience, especially if I'm not a finance person. I can, and I don't know, maybe you're not going to appreciate it, but I can use you for a little bit like practice before I go to VCs, right? Am I thinking about it straight? Does this add up? My financial projections, does it sound reasonable? And so, and then with a little bit more confidence, because I have nothing to lose with you, right? On the other hand, if I have specific VCs, especially if I'm in some sort of niche market segment, I don't want to come unprepared. So I could also use a little bit like, okay, I'm going to get a debt facility at the end or some sort of debt. And at the same time, I will be better prepared to talk to the VCs, because through this process, I will learn, or at least I will validate my thoughts and my materials.
Yep. Yeah, that makes great sense. Just a reminder to everybody who's on, feel free to drop questions into the Q&A box, should you have them, and we'll make sure that we get them answered. When you touched on something that I just wanted to share a quick rule of thumb on for CEOs who are thinking about taking debt. We think a lot about, just as you said, there is a sweet spot. It's possible to take too much, and then once you take too much, you could put your company in a bad spot. We call that the debt spiral. If you take too much debt, then you're going to be spending too much to service that debt, and it becomes very hard to operate the business. So we think very carefully about that. We're very purposeful about sizing the amount of capital that we're going to provide to a company. And there are a couple of rules of thumb that I like to think about that when I'm talking to CEOs and they're asking me, well, how should I think about this? There's a couple of things that I think might be helpful for anybody thinking about it. You typically want to try to make sure that what you're paying for your loan isn't going to be more than like 8 to 10% of your monthly revenue, because you've already got a bunch of stuff that you're paying for, right? You've got payroll, which is always going to be your biggest expense. You got other stuff. When that money comes in, you want to make sure that you can deploy it, earn a return, and afford the payments. What you don't want to do is take a loan and then spend the loan to pay back the loan over time super fast, right? So that's another thing to think about, is the term that you are signing up for. Short loans, 12 months, those are tough to pay back and get a return on the capital that you're deploying. So generally 24 plus months of term is a good maturity for a loan for companies in this sort of space. And then when you think about how big the loan should be, we typically are about 20 to 25% of a company's revenue. And we're typically doing 2 to 3 year loans, right? And what that means is, if you think about it, it's like 10% of your revenue for however many years the loan is active. That's about the right size if you're taking a loan and you're a technology company. Simple rules of thumb that I think are useful when, as a CEO, especially CEOs who are thinking about debt for the first time. How am I supposed to know how much is too much or how much is too little? Those are the rules of thumb that I typically think about when I'm talking to these kinds of CEOs. So, again, any questions that pop up, please drop them in the Q&A. Tom, you were going to say something.
Yeah, I was just thinking to add a highlight. Like when I work with people or with other companies, I like to think how motivations align, right? Yeah. And raising VC for high growth, it's kind of inevitable path, or there are not that many ways how to go about it differently if you want to build like really, really big company, right? But the motivation in the beginning, when you are in the negotiations and so on, the motivations with the VC might not be aligned, right? There might be VC who wants you to take as much money as you can, right? Which might not be good for you. And they might also push on the valuation or take less capital, be careful, and so on. But like on the debt, when you're thinking about it, the motivations are aligned, because the lender doesn't want you to take too much of that. That creates a risk. And if it's too little, it might not be interesting or relevant anyways to make a difference, right?
Right.
So actually, in this sense, I feel like that the motivation between the founder or the founding team and the lender is aligned, at least at these early stages. I like to look at data and think about it. That because if you're buying some other service, they might want you to buy as much as you can, right? Like, hey,
Right.
here's a candy, and don't you want this candy and also this candy? Well, have the whole
Right.
shop, right? But in this case, there are actually guardrails, right, on both sides, too much or too little.
Yep. Yeah. That's great. So let's talk about raising capital. We've kind of touched on it. We've danced around the idea and some of the advice that I think you probably have a particularly unique view on. You know, how should I frame this question? Lenders and VCs look at the world quite differently, as you know. So, and you've experienced both. So, how when I'm a founder and I'm getting ready to raise capital, what do I need to know about the two kinds of capital? What do I need to know about the two kinds of capital providers and their mindsets and the differences between them?
Hmm. I think that, well, where to start? It's complex, right, to unpack. So
Right, it is.
I think we should pick maybe a stage, right? And like raising
Sure.
a pre-seed and seed has very different dynamics and very different kind of data points which are critical. Uh, Maybe from the lender perspective, it's similar between seed and
Mhm.
A, but I think from a VC, it's very, very different what kind of criteria they employ, right? And you as a founder, if you are a first-time founder or and you don't have the financial background, then let's say that if you are doing pre-seed or seed, it's a lot about obviously the team, but also the size of the market, for example, right? And you don't have that many data points to share with
Right.
the investor yet. And if whatever data you have, it might not be that reliable because it might be just too few users or too little revenue and so on. So like, I don't know, if they ask you for customer acquisition cost, you might have it by then, but it not might be really telling because you have 10 enterprise clients, right?
Right.
While when you are at the A round and when we are raising later, and I'm sure that you see it with the underwriting as well, you can start working with, if you're B2B SaaS, you can start working with cohorts. You have some sort of kind of predictability to this, and the focus changes. Right? But initially, we went out to raise money, and then we asked for that. In this case, like the last round with it, and but then we realized that actually when we were picking who the lender would be, it was much faster, and thanks to that, we could wrap up the round quite fast. So we should have actually gone out and asked for the debt earlier. And I think that it can't hurt. Again, what I said earlier, right? It can't hurt you. Lender will be always happy to talk to you half a year later, even if you did not show up best prepared or so on. While
Right.
with the VCs, they might be like, oh, this person doesn't know what they're doing.
That's a
And
great point. That's a
they will
great
move
point.
on. Right. So I feel like I'm repeating myself, but I think that, yeah, use the lenders as a practice round. And
Well,
sorry.
learn, learn from the lender. There you go. Say it like
Yes, learn from
that.
the lender and then go to the VCs. And the VCs, they have very different motivations, right? And they have also different preferences. So it's very difficult to put, like, someone might be focused on what is the ownership they will take.
Right.
And then they might be giving you a smaller ticket and press down on your valuation. Someone might do it the other way around and say like, well, we don't care if we give you 1 or 3 million at the seat, right? We just optimize for this. So then, but you can't figure it out. It's not like you can go on Google and figure out what are the criteria. You can figure out what are the lending criteria, right? You can ask, and it's very easy to find. But when it comes to VCs, they don't publicly tell you, oh, I prefer teams like this, I prefer graduates like this, or I prefer experience of the team like this, or size of the market. There are some who are specialists, but you still don't know what their priorities are, right? And you will have
Right.
to discuss with them. So it's always better to be very prepared so you can navigate the discussion a little better and kind of collect what's their criteria.
I totally agree. Um, you have a fairly large customer set and a very large data set. You have tons of companies on your platform. How many companies do you have on your platform?
Well, the registered companies is over 22,000 currently.
That's a lot.
But as I said, we serve companies who start from splitting equity among the founders
Right.
or kind of getting angel or family money first. So not everybody makes it to later stages, right? As we talked about it,
Yeah.
the math of VC funded companies is brutal. But yeah, 20,000, 22,000 registered companies and thousands of companies which are active and are also valuation clients.
So we've talked a little bit about what happens when a company raises the wrong kind of debt or too much debt. What happens when a company raises too much venture money? I imagine on your platform, you've seen some of that kind of stuff happen.
Yeah, I think that especially the 2021 and 2022 cohort
Hmm.
uh, is a good one to mention. And you can see that like that year, right, the valuation spiked. And for a while it looked like any valuation goes and a lot of new big funds came in, a lot of money, which didn't really care about in the end, came in,
Hmm.
and many startups raised at high valuations, and many we don't see they have raised after, right? Because once the pendulum swings back to kind of this, the medians and averages, right, the kind of
Right.
mainstream, once the pendulum swings, you are overvalued, and it's very difficult to grow into it, right? And that's what I was saying earlier. Right? Like the motivation of the VC might be different, right? It might be ownership, and then they might press down the valuation and be a little more pragmatic, which might be actually good for you as well,
Hmm.
right? It's not always that's not the rule, right? I want to maximize my valuation. No, because it might feel like a quick win, but it's on paper. You will have to grow into it. You will have to
Yes.
deliver on that, and sometimes it's better to split it into smaller steps, right? And I think that the 2021 party, there is a lot of hangover around still, and those companies will have it very difficult to figure out what to do.
I agree. I agree. It feels good to raise money at a high valuation before you've grown into that valuation. But like you said, you have to grow into it, and growing into it is not easy, right? It means you got to run harder than you're already running
Yeah,
um,
exactly.
to
And
catch
so
up.
we see, yeah, we see from the founders, like especially at the early stages, right? Like it's difficult. There is not that much data out there, so it's difficult for you to go out, and if you don't have the financial background again, or you haven't been founder
Yep.
before, it's like, okay, what is the investment valuation? What is the pre-money, post-money? What is the fair market value? How do I guess what can I exit at in 3, 5 years if I'm even meeting my criteria, right? And
Right.
quite often, what I feel like is, uh, especially the 2021, 2022 party, was no one was really thinking like, hey, what is the exit potential here in those, right? And basically, the fair market value of the companies was remaining similar,
Yep.
but then the investment valuation grew, and you have to deliver on that. Otherwise, someone's going to lose money if you're if you are being acquired or you want to IPO, right?
And who
Well, when
loses
you
that money? Who's the one who loses money, Tom?
well, you tell me, but
Well, it's the founder.
often
It's the
exactly.
founder.
I was about to say it's often. I don't want to use the term usually, as we can interpret it in different ways, but it's
Right.
often the founder who gets beaten
Yeah,
on this, right?
that's right.
And in a way, it's correct, right? If you raise a too high valuation and you can't deliver, then that was your decision,
And
and you
so
get
that's
beaten
the
at the end
market.
of it.
Yeah.
But the problem is if you made the decision without being really informed about the consequences, and you kind of did not have the additional data points to make the decision, right? And it's not always in the interest of other people to tell you what the truth might be, right? Or what are the probabilities? What's the reality, right?
I think that's one of the things that I've always found really interesting when I'm out on the fundraising trail, whether I'm raising equity or debt. You said something very important. This has turned into a conversation about raising capital, which is great because I love talking
The
about
other
this
part of
too.
it,
Yeah. Uh, what was I going to say? Oh, you said a lot of folks out there aren't going to tell you like, well, this is the downside of the deal that I'm offering you, right? That's 100% true. And it's very, very important for founders when they're raising capital, whether it is debt capital or whether it is equity capital, to spend time understanding who it is they are talking to and who it is they're taking capital from, right? Because you want to make sure that at the end of the day, we talked about this a little bit before we dropped into the webinar too. At the end of the day, providing capital it is a relationship business. You have to have a relationship with the person who's giving you money. You want to have a relationship with the person who's giving you money. And part of that is asking tough questions like, well, maybe I love the valuation, but what happens if I don't get there? What happens if what happens in the case where I do some sort of an acquisition at a lower valuation, and really talking through like how does that affect me as a founder? Because by the math, in a lot of cases, it affects you very very dramatically, because your common stock is always at the bottom of the stack. So I think having those conversations
Exactly.
and being very purposeful about that is critical. And some people might say, we don't want to talk about that because that signals that maybe you think your business is weak and you're not going to get there. I think you have to think about all of your potential outcomes and have
Exactly.
conversations about each one of those. And if you're not comfortable doing that with the provider of capital that you're talking to, then it's probably not a provider you should work with.
Exactly. And you don't talk about it publicly, right? But like internally as founders, we always had like, what is the worst case scenario?
Right.
Like there's always the bankruptcy, right? But then
Yep.
you don't need to really be thinking about it. But like, what is the worst case scenario? Things are going okay.
Yeah.
We will need to enter some liquidity event, but it's not in the ranges we were aiming for, right? Are we all losing money? Who is getting what, right? And
Right.
how do we make it still kind of meaningful or reasonable, even if things don't go super well? Because the odds
Right.
are it's not gonna go super well, right?
Oh
So
man, that's the
I, I
truth.
I like to approach it this way. Obviously, you can't always say that to other people, but in as founders, as a group, I think you should be very thinking about it. Like, hey, if things go decently well, and in 3-5 years we might have the exit opportunity at these levels, are we still getting anything back or not?
Yeah,
Right. And it's a tough journey to be a founder. So you better think
it
about it,
is.
right? Like you don't want to regret 5-10 years later. Oh, and yeah, I think there's a question.
Yeah, there is a question. So Richard asks, are personal guarantees required for your loans? No, for our loans, we do not require personal guarantees. I know there are some folks out there that do want to have personal guarantees. We have kind of a unique view in the market, maybe a unique view. I think it's a unique view. Um, we want to underwrite your company and not your personal assets. So which means we're willing to take that risk. So yeah, no, we don't take personal guarantees. We do file a UCC one, which is a claim on assets of the business, except for IP. We actually carve out IP so that founders can be more comfortable with that. But great question.
That is
Um,
a great question. Yeah.
yeah.
I did not realize. I should have crossed my mind because, like, so with my previous company, and so the very first loan I took, it was fully personally guaranteed.
Oh,
And then I went for Angel. And then the second loan, I think, wasn't. And then the third loan was guaranteed by my shares, part of my
yeah.
shares, significant amount of my shares, actually.
Yeah.
But at that point, we were decently confident we would repay that, even if things were kind of modest case scenario. But
Yeah.
it's a good question, yeah, because, and I remember now I spoke with some founder recently who was also like, oh, but I don't want to personally guarantee a loan. I'm like, no, there are options where you don't need to. So it's good to stress. Thank you, Richard, for your question.
Yeah, it's a great point. One of the things that I mean, we thought long and hard about whether we should require personal guarantees, but at the end of the day, our point of view is this: you as a founder are taking enormous risk, right? Like you could not be doing a harder job. And so for us to say, oh, and by the way, if things go sideways, we want to get through to your personal assets too. Like no, that's terrible because I have zero interest in in a personal guarantee when I'm building novel. I don't want to. I mean, I'm taking enough risk
Uh,
already.
and
So
exactly. Well, you and also the founder, right? Like being a founder is tough, and
yeah,
especially in the very early beginnings, right? And you're just losing so much. Like the opportunity cost of being a
yeah.
founder is so high, the hours worked and everything. So adding personal risk on top of that, I could afford it back then, but I would not recommend anyone doing it again.
Yeah, yeah. I would not recommend it either. So Rich asks a couple of questions. What's the loan size, min max? I'm assuming you're asking what we do at Novel. Smallest check we'll write is 100K, largest is 5 million. Um, and it is totally a function of the size and growth and metrics of the business. Min max in company sizes, $1 million in revenue and up. The biggest company we provide a capital to is 20 million, but we like to go 1 million in revenue and up. So hopefully that's helpful. Um,
So that's basically somewhere like seed stage, right? Like if you think about funding stages, maybe when you're raising angel, it might be a little too early, and you
yep,
have first 100K in revenue. But once you are getting closer to a million, you should start kind of looking around what kind of debt loan opportunities there
that's
are. And
right.
I think generally maybe start thinking about it like once you're crossing somewhere 300 to 500K, and
Yeah,
then you see, so you collect the criteria from the lenders, you know where to draw the line, or what are the milestones, and then you can see, okay, I raised for angel this, now I want to go pre-seed seed, this size, and you see how you can add
right.
up to it, right? And can actually loan bridge me to a little later to raise at the better terms and have,
Yep.
maybe not the terms are so important, but actually the more traction you can prove, right? Or more evidence you can not manufacture, but produce for the VCs, the better. So if you can
Right.
bridge it with a loan, I think that's worth contemplating.
I think you just said something that sparked another thought. As you grow, you're going to get better terms from VCs, right? If that's the path you're on. The same is true on the debt side. So, that first loan you take when you've got 800K, $1 million in revenue, it's not going to be a bank interest rate, right? It's going to be more expensive than that because there's a lot of risk still in the company. I hate to break it to you, but it just is what it is. Um, but as you grow, that risk comes down. And so the price of the debt comes down. The terms of the debt get a little bit easier. So I think that's one thing to think about too. If you're out raising capital and you're talking to a lender, I mean, if I was talking to me, one of the questions I would be asking would be, if I'm a year into my relationship with you, 2 years into my relationship with you, are you going to bring my pricing down if my business is getting less risky? And our answer is absolutely, because we're looking at risk and we want to bring the price down as you continue to grow. So you want to have a mechanism for that when you're talking to lenders about raising debt capital.
And when it comes to, because like, and when it was my first VC funding company, I was
Hmm.
kind of inventing things or learning things on the fly, right? Which
Right.
is not exactly efficient, right? How do you guys see? Uh, because yeah, again, majority of founders don't have financial background, right? How early do you see, or how early do you recommend to work with someone who has seen this before, right? Like an interim CFO or someone who has been around startups, like, and do you see more that these people involved more in an advisory role, so that they give opinion to the founders, or do you see like that there is a meaningful difference if
Oh,
you
that's a
invest
great
into
question.
interim CFO?
That's a great question. Um, if you are if you're a founder and you haven't done, if you haven't started a company before and you don't really have a good grounding in accounting and finance for an early stage company, there is a point where it makes a huge difference to bring in a fractional CFO or something like that that can really get your accounting and your books, and very importantly, how you think about finance on the right track. We see an enormous difference in companies that come who don't have an expertise in that area, and who haven't outsourced it, who haven't brought somebody in to help them think about it, and those that have. And when we're underwriting a company, we get way faster, way farther, I said that the wrong way, way farther, way faster with a company that has some sort of fractional CFO or somebody with that kind of expertise, because they sort of already know, okay, look, these guys are going to ask these 9 questions, and I'm going to get the CEO ready, and the books are going to be the way that they should be, and all the stuff that a finance person knows gets deployed into the company. And it's hard, it's painful, and it's a lot of work, but it certainly makes life a lot easier if you're the founder and you're trying to raise capital on the debt side and on the equity side. So typically what I would suggest is if you've got $500,000 in revenue, start thinking about who can I bring in to help me. And if you're at 1 million in revenue, really start looking if you haven't done it yet, because there are very well priced fractional CFOs and other advisory firms out there who can spend a little bit of time with you on a weekly and monthly basis and make a huge difference.
I can get behind that. So as I said, I learned things the hard way because I always felt like I have to figure it out myself as a founder. And I should have worked with fractional or interim CFO just to skip the learning curve. And all of a sudden, like if you as a founder spend on something 3 months instead of 1 month, it's actually a huge, huge, huge difference. So nowadays, when I work with startups and there's no one with the financial background in the team, I always recommend them to find someone. And interestingly, I've seen also a change, like, well, for example, the board dynamics when the fractional CFO brings the credibility and experience to early board meetings and kind of
Hmm.
clarity. It helps with planning, with thinking, and it helps the founders to wrap their hands around like what are the kind of optimal scenarios and not to just focus on one, right? Like I said, high valuation, I
Yeah.
will get a lot of money and then everything will be fine. And that's not how it works,
I
usually.
think we usually, I think we are coming down to the wire here. I see that Rich asked another question. I'm going to just give you, Rich, my email address and invite you to just shoot me an email. Yes, we can talk about it. Happy to explore. So hopefully you just got my email address. In case you didn't, it's keith@novelcapital.com. It's fairly easy. Alex with the late breaking question. Regards to applying and drawing debt, is it more typical for companies that are below your 8 to 10% debt to revenue mark to draw up to that 8 to 10 in current state, or for companies to draw beyond that and grow into it? That's a great question, Alex. And this gets to that idea of can you take too much debt or equity? And I think Tom and I agree, yes, you can. Um, the idea of your question is, will they draw? Will a company draw more than maybe they should and then grow into it over time? That would be something that we would want to avoid. We would try to keep that company down to if we're doing a 2-year loan and you're $1 million in revenue, we would say, on average, 250K is what we would be comfortable lending. We would not want to say, hey, we'll loan you 300K and you can grow into it. Sometimes, however, what we will do is put milestones out there. If you grow and hit this milestone, we'll make more capital available to you. So hopefully that answers your question. Shoot me an email at keith@novelcapital.com if you need any more information on that. I want to be respectful of everybody's time. Tom, thank you so much for your time
Thank
today.
you, Keith.
This was a great
It was fun.
conversation.
And thanks
Yeah.
everyone for showing up.
Yeah, thank you. Thank you to everyone. If anybody wants to contact either one of us, you can see our contact information here. Please do not hesitate to reach out. Tom and I are both a little bit passionate about this topic, obviously. I think we could probably go another hour, but sadly we
Next
can't.
time.
So next time. Thank you, everybody. Tom, thank you again for your time.
Thank you, everyone.